Welcome to Manifested Publishers.
Hello and welcome to the economics lesson. Today we are going to study monetary policy instruments. By the end of this lesson, you should be able to explain the various instruments or tools that the central bank may use in monetary policy. The first instrument is known as open market operations. Number one, open market operations. Open market operations. Open market operations is an instrument that the central bank can use in monetary policy, in developing monetary policy. And it consists mainly of purchases and sales of government securities, eligible papers, securities, eligible papers, but candidates' operations in bankers' acceptances and in certain other types of paper are often permissible. So in open market operations, they may be use of the bankers' acceptances. And the open market operations as a monetary policy instrument of monetary regulation is only effective in countries with well-developed securities market. That's number one. Number two, reserve requirements. Reserve requirements. The central bank may require financial institutions, especially the depository institutions, to set aside a percentage of their deposits as reserves that are to be held either as cash on hand or as account balances at the central bank. And if the central bank feels that there is too much money in circulation, it can in addition require commercial banks to maintain over and above cash or liquid assets, together with some additional reserves in form of special deposits. So the commercial banks, in this case, are asked to maintain additional deposits in their accounts at the central bank. That is the second instrument that the central bank can use in developing monetary policy. And remember, when we defined monetary policy, we said that monetary policy is a macroeconomic guideline that the central bank gives in order to regulate the supply of money in the economy. So reserve requirement is an instrument that the central bank can use, especially when there is excess money in the economy. The central bank can require or request the commercial banks to set aside a certain amount which can be in form of cash at hand or an account balance. The central bank may also require the commercial banks to have additional deposits in their accounts over and above the reserve requirement. Do you understand? It's a very straightforward concept. There is money, a lot of money in circulation in the economy. Okay? Or money that is being held by the commercial banks. The central bank may require these commercial banks to open accounts or to have some cash in hand at the central bank. Cash in hand, cash on hand or account balances at the central bank. So that if there is, this is say 10 trillion, the central bank can request the commercial banks to have some of this money being held as reserves at the central bank. Because remember, monetary policy is the role of the central bank to come up with monetary policy so that there is no excess money in circulation. So this money can be held, some of this money can be held as reserves at the central bank. Reserve requirement. The central bank, I repeat, may require all depository institutions to set aside a percentage of their deposits as reserves to be held either as cash on hand or as account balances at the central bank. That's one instrument that the central bank can use in developing monetary policy. Number 3, discount rate. How is the discount rate a monetary policy instrument? Now, candidates, this is the interest rate a central bank charges eligible financial institutions to borrow money on short-term basis. Okay? Transactions known as borrowing at the discount window. The transactions are known as borrowing at discount rate, or borrowing known as transactions borrowing at the discount window. The discount window. And candidates, the discount rate is set by the National Bank, subject to the Board of Directors approval. So the level of the discount rate is set above the normal funds target rate. And as such, the discount window serves as a backup source of funding, or it's a backup source of funding for depository institutions. And therefore, the discount window can also become the primary source of funds under unusual circumstances. Discount rate. Number 4, variable reserve requirement. Now, how is variable reserve requirement a monetary policy instrument? Candidates, the central bank controls the creation of credit by commercial banks by dictating cash and liquidity ratios. By dictating cash and liquidity ratios. Cash and liquidity ratios. The cash ratio is obtained by dividing the cash reserves. We can divide by the deposits to get the ratio in form of a fraction. We can divide here deposits That is the cash ratio. Cash ratio is equal to cash reserves divided by deposits. Divided by the deposit. This is the cash ratio. And the central bank might require the commercial banks to maintain a certain ratio of say 1/8. Of say 1/8 or 1:8. Okay? That means that for every 1 shilling of cash reserves, the commercial banks can have 8 shillings in form of deposits. Okay? And that would mean that the banks can create deposits exceeding 8 times the value of its liquid assets. Cash reserves, these are liquid assets. Then there is the liquidity ratio. Liquidity ratio. Liquidity ratio is obtained by adding the cash plus reserve assets over deposits. And this is the same as cash deposits. This is not cash deposits, but cash over deposits, plus reserve assets over deposits. That is the liquidity ratio. Cash over deposits plus reserve assets over deposits. And candidates, in most developing countries, the central bank requires that commercial banks maintain a certain level of liquidity ratio. And this level shall be varied or can be varied by the central bank depending on whether the central bank wants to increase money supply or decrease money supply. So this is an instrument that the central bank uses when developing monetary policy. So the ratio can vary depending on what the central bank intends to do. If the central bank intends to increase money supply or reduce money supply, then the liquidity ratio is an instrument. We are calling it the variable reserve requirement. That is instrument number 4. Instrument number 5, the 5th instrument, is known as moral suasion. Moral suasion. And the dictionary meaning of moral suasion, candidates, is that moral suasion is the act of persuading a person or group to act in a certain way through rhetorical appeals, persuasion, implicit or explicit threats. Okay? As opposed to the use of outright coercion or physical force. In economics, it is sometimes used in reference to central banks. So moral suasion is a qualitative method of creating credit being used by the central bank. Under this method, the central bank merely uses its moral influence on the commercial banks. It includes advice, suggestion, request, and persuasion with the commercial banks to cooperate with the central bank. Now, candidates, when we describing moral suasion, as an instrument for monetary policy that the central bank can use. The central bank can use suggestion, as we have read, can use advice, can advise the commercial banks on the levels of liquid that is required in the economy. As opposed to coercion or any other means, the central bank can use moral suasion. Moral suasion. Without actually using any of these above instruments, okay, the central bank can attempt simply to use moral suasion to persuade the commercial banks to restrict credit when they wish to limit monetary expansion. Instead of setting ratios that commercial banks must adhere to, instead of using reserve requirements or discount rate or open money operations, the central bank can use moral suasion to persuade the commercial banks to restrict credit, when they wish to limit monetary expansion. The central bank can write to commercial banks to limit monetary expansion, and the central bank uses its moral authority that it has over the commercial banks. Moral suasion, or we can say even direct control. Direct control. Moral suasion and direct control. So these are 5 monetary policy instruments. Thank you for attending today's session. We will continue to learn more in our next class. Bye-bye.
Welcome to Manifested Publishers,